are going to see that reserve diversification continue to work its magic.
Hi, everyone, and welcome to our Views from the Desk podcast. I'm Erika Toth. I'll be your host for today, and I'm joined by my colleagues Bipan Rai, Managing Director and ETF and Alternative Strategist, and Matt Montemurro, Managing Director and Head of Fixed Income and Equity Index ETFs. So this year has been a very exciting year so far in the ETF business in Canada. Inflows have reached $73 billion as of the end of August. That's a pretty staggering number. So just to put things into perspective a little bit, 2024, the full year inflow across the industry was $76 billion. And last year was a record year for the industry. BMO's ETF business hit $149.9 billion in ETF assets at the end of last month, with net flows of around $12 billion so far this year. We continue to be the second largest player in the industry, but the largest when it comes to fixed income ETFs, factor ETFs, covered call ETFs, and sector ETFs. So even though flows slowed a bit industry-wide for the month of August, so around $7.3 billion of net inflows for the ETF industry, equities still dominated the inflows side of things. So about $3.8 billion worth flowed into equities for the month of August. So far, that was the smallest net inflow month for equities this year. And within the equity category, it was actually international equities that were the top seller, bringing in about $2.7 billion. And actually ZEA, which is the BMO MSCI EFI ETF, was at the top of the list, so the top selling ETF in Canada for the month of August, bringing in about $626 million. So Bipan, let's kick things off with you today. What do you make of the flows slowing down a bit? Do you think that the international equities trend has legs from here on in? Also wanted to get your thoughts about the fact that U.S. equities had just under half the amount of flow that the international equities did last month. So about $1.2 billion was the net inflow number for U.S. equities. And this was primarily going towards broad index trackers, S&P 500 index ETFs, such as our ZSP, the BMO S&P 500 ETF. We brought in $182 million last month into that ETF, as well as some U.S. total market ETFs. So wanted to get your thoughts on those trends, Bipan.
Certainly, I mean, there's a lot to unpack there, but let's talk a little bit about the slowdown that we saw in August. I mean, there's several different factors, Erika, that we could look at, potentially for driving that slowdown for August. One of which, I mean, I think this is obvious. There's that seasonal element to flows, right? And we do tend to see flows slow down towards the end of summer, obviously into the start of September. And that, of course, could be reflective of what is happening with respect to the broader macroeconomic backdrop. And, what was special about this August relative to prior Augusts? Well, if we were dealing with prior August, we didn't have to deal with the uncertainty of a trade conflict. And if you recall, at the early part of this month, of course, in the United States, we did, have to contend with the possibility of Liberation Day 2.0, where we were getting different country by country IEPA tariff rates levied by the United States. So it does feel like that, investors were holding back a little bit and, really seeing where the chips fall with respect to market response in conjunction with these new tariff rates. And at the same time, there does appear to be this new, let's call it, stagflation risk. And I don't use that word lightly. I mean, we are seeing signs that, the labor market backdrop in the United States is becoming a little bit more patchier. At the same time, if we look at core price inflation in the United States, it's a little more stickier than, we would argue that the Fed is comfortable with. But nonetheless, they are getting ready to look at or entertain the idea of a rate cut as soon as next week. Beyond there, we do have some disagreements with the way the market is pricing the FOMC. But again, we'll come back to that, I'm sure, a little bit later on. But that to us suggests that there is a little bit of reluctance when it comes to flows for the month of August, and also some degree of a healthy degree, we would argue, with respect to the United States relative to, say, the international market. And, if we look back to where we were at the end of 2024, you can make a reasonably sound case that the market was incredibly overweight the United States relative to other regions. We think some of that is being adjusted, and that is, of course, something that's being reflected in the flows. Now, is this at a certain point where we think international ETFs have peaked relative to what we've seen in the last couple of months? We still think it's too early to say that. I mean, if you look outside the United States, if you look outside of North America, there are a lot of positive stories out there, notwithstanding the political risks that we're seeing develop in places like France and the UK. If you look at the fundamentals, not just of the ETFs, but also the emerging market space, there's a lot of good stories there. We think that investors will be keen to opportunity to capitalize on those, I should say.
So, Bipan, as it relates to the United States, I wanted to circle back on that for a second, because in your research earlier this week, you highlighted that you think there's the opportunity for the US dollar to weaken a little bit more. And your call was for Canadians to start considering Canadian dollar hedged ETFs for their US exposure. So do you want to chat with us a little bit further on this?
Absolutely. And I should emphasize that any time that we make a currency call here, we tend to move for or really make that call on a tactical basis as opposed to a strategic basis. I mean, currency calls are notoriously difficult. And again, the asset class is itself notoriously volatile and fickle. And so, over the course of the next 3 months into the end of 2025, is there a case for the US dollar to go lower potentially? We'd argue yes. I mean, I mentioned the stagflationary backdrop that's developing in the United States. The medicine traditionally that the central bank has used to address any sort of stagflationary risk has been higher interest rates. This time it's a little bit different. Now you're starting to see more and more of a pivot or a shift towards entertaining the notion of rate cuts. And, the more the market prices this in, the risk is that inflation expectations, on the part of market participants in the U.S. will increase. And we would argue that it's going to erode the nominal value of a lot of savings and asset holdings in the United States. And that could lead to momentum of flows outside the United States into other jurisdictions, which again are bearish to the US dollar. The second factor potentially to look at is the rise of political risk. Now, this is something that's notoriously very difficult to model in the foreign exchange risk. The simplest way for me to say this is the erosion of trust in key institutions like, say, an independent central bank or, say, an independent national statistics agency. Anytime we get data out of the United States, there is going to be this premium of, can we trust this data? Is that non-farm print actually plus 27K and not something a little bit lower than maybe the White House is sort of projecting, or at least it would like to send as its message to the rest of the country? Those are things that we think are going to be bearish for the US dollar. Full stop.
Thanks for expanding on that, Bipan.
Managing your own portfolio takes time. Researching markets, juggling spreadsheets, and constantly rebalancing. But what if you could skip the stress without sacrificing strategy? That's where BMO All-in-One ETFs come in. These ETFs are designed to simplify your investing journey with automatic rebalancing and a diversified asset mix, helping keep you on track without the high fees. With tickers that start with the letter Z, you can just Z it and forget it. To learn more about all-in-one ETFs, visit our website at bmogam.com. That's bmogam.com.
Matt, over to you on the fixed income side. When we look at the net inflow picture, it was just under $2 billion last month across the Canadian ETF industry. One of the notable trends that we saw was money flowing out of money market type instruments and into things like Canadian corporate bonds, aggregate bond ETFs, as well as more international bond ETFs. So Matt, what would you say, first of all, is behind this trend? Also want to get your thoughts on what some of your top picks would be right now in the bond ETF space. The Fed is pretty much teed up to cut rates at his next meeting. Many market participants, most would say that this is priced into the market already. So also want to get your thoughts on duration and, where on the yield curve investors should be thinking about positioning right now. I know that's a lot of stuff I just threw at you, but love to hear your thoughts there.
No, happy to tackle it, Erika. Thank you. So, duration is certainly a hot topic of conversation right now. Almost every conversation that I have with clients is centered around where to be positioned for the period ahead. To say that there's uncertainty in the market, especially in fixed income, I would say is an understatement. I don't believe that some of the outflows that we've seen in the short end, that money market, those HISA ETFs, is truly reflective of a fundamental shift in sentiment in the market or a full-blown repositioning of portfolios. While I do think that time will come, I'm not sold that we're there yet. And so, there still continues to be inflows in other short end products like ZST. It's seen steady inflows and continues to be sought after as a yield enhancer for portfolios. And I'll be honest, that cash, that short end positioning continues to be stubbornly sticky and resilient. So I do expect that to start to change. I don't think we have started that inertia process where I don't think we've started that process of getting money off the sidelines, but I would expect that trend to start in the period ahead, maybe starting really in 2026 as we start to see the Fed really ramp up maybe that cutting cycle. Investors are certainly talking about adding duration to portfolios, but I do think, and I've heard Bipan say it before, risk premiums are looking to be rising globally, and I'm not sure that I see the trend of investors going long duration as a whole right now. The market right now, if you look at what's the market pricing in, it's pricing in almost 3 cuts by the Fed by year end, only 1 cut here in Canada. Market is also pricing in a Fed path to below 3% right now by the end of 2026. So a pretty steep cutting path for the Fed from now, basically a year and a half forward. In Canada, we've already undergone a lot of the early stages of that cutting cycle. It's definitely a much more muted pace going forward, with right now 1 more cut priced for 2025 and 2 more cuts priced until midway through kind of almost the end of 2026. So from a positioning perspective, right now, we prefer Canadian to U.S. fixed income as a whole. Generally, we prefer Canadian duration to US, while we wouldn't be going all in on long duration today. In that sense, I think we prefer allocations to an aggregate exposure like ZAG, so the BMO Aggregate Bond Index ETF, versus ZUAG, which is the BMO US Aggregate Bond ETF, in that near term, that period ahead. Looking at the credit space, even though credit spreads are historically tight, we do still see value in sub-sovereign debt versus sovereign debt, and we would position ourselves on the shorter duration side of this. So some fixed income allocations that I think are well positioned right now, ZQB, our BMO High Quality Corporate Bond ETF. So a reminder, it gets 1 to 10 year Canadian bond exposure, A-rated and above. So overall duration ends up being just above 2 years. So again, you're hugging that short end. This fund is a nice balance between that short duration exposure, yield enhancement over or federals or government exposure, but you're still protecting yourself on the downside by getting that A-rated bonds, those higher quality bonds in your portfolio. Another option is ZCS, our BMO Short Corporate Bond ETF, or the US alternative, ZSU, our BMO Short-Term US IG Corporate Bond Hedge to CAD Index ETF. If I was to choose today about those two, I think that ZSU might have a little bit more near-term value and upside, but I do think both are well positioned within your portfolio to help weather some of that volatility and uncertainty ahead.
Thanks, Matt. So Bipan, I'd like to chat with you next. Given your research and your publications around sectors, I want to pick your brain because there does seem to be a little bit of a sector rotation going on in the flows. Over the last month, we saw some outflows in a few Canadian sector ETFs. So Canadian banks, there was a bit of outflows. Canadian REITs, there was a bit of outflows. Energy. There's also some outflows in the U.S. banking sector. So I wanted to get your take on these flows and where do you see the best sector opportunities going forward?
Sure. So, me and my background as a macro strategist, I tend to look at things from, say, a 30, 40,000 foot viewpoint and really drill down from there. So first thing I'm always going to look at is, what is the data telling us about where we are in the economic cycle? Right. So, as dry and as boring as it can be sometimes, I have to parse through the employment numbers. I have to parse through the sentiment surveys. And basically everything is aligning and telling me that we're migrating from a period of strong growth, not just in the US, but also in Canada, to a period of slower growth. Now, of course, degrees matter. And this period of slower growth can metastasize into something like a recession, but it still wouldn't change my answer. Usually when you're in that sort of backdrop of migrating from strong growth to slower growth, you want to focus on quality, right? Typically, these are the sort of factors that tend to outperform. Now, within quality, there's a couple of ratios that we like to pay attention to. First being return on equity, second being return on assets, and then really looking at operating margins after that. And what we've done in the past is we've taken these three ratios, we've ranked all the different sectors in both countries by them, and we come up with a pretty decent guesstimate for which sectors should continue to do well. And you wouldn't be surprised to note that some of these have already done well. We think there's probably still some additional leg room, given the fact that we don't think we're out of this sort of rotation story from strong growth to slower growth. So the United States, believe it or not, surprise, surprise, technology and communications have done extremely well in this backdrop. And now, is this a trend that could continue? We think so. So, if pairing that also with our call for potentially the U.S. dollar to underperform relative to the Canadian dollar. A couple of ETFs that we would ask our listeners to entertain is the ZXLC.F, which is of course the BMO Spider Select Communication Sector ETF. The other one is of course the ZXLK, which is the BMO Spider Select Sector Technology ETF. And these are ETFs that have done well, and we still see some further upside on a go-forward basis. In Canada, again, the story shifts a little bit because you can't really look at the same sectors in the United States as you can in Canada. Two totally different markets, two totally different economies. So you're going to see different outputs when we sort of look at those same screens for quality. In Canada, again, it's very much a story about industrials and, believe it or not, materials. Materials has done well as a sector as well this year. So if we're talking about industrials, we've got a fantastic ETF that I've referred to a few times in our research write-ups. This is the ZIN, which is the BMO Equal Weight Industrials Index ETF. And, for materials within that, obviously gold miners have done reasonably well. That is a story that we think could continue. So something like, say, a ZJG, which is the BMO Junior Gold Index ETF, is another ETF that we're looking at as we conduct our sort of our quarterly analysis of our guided portfolio strategy.
Thanks, Bipan.
It's the small things that make us Canadian. At BMO ETFs, all of our tickers start with Z. That's right, Z, not Z. From ZSP to ZEB, we know how to build solutions for the Canadian investor. So the next time you invest in ETFs, consider a Z instead. Visit BMOETFs.com for more.
So Matt, I'd like to turn it back over to you. One huge area of growth in the ETF space has been the popular all-in-one asset allocation ETFs. If you look at the flows, almost $1 billion went into the all-equity asset allocation ETFs, so the ones that have 100% equity exposure. If we look at the category itself, we're looking at about $13.5 billion so far this year, which is close to 20% of the flows for the entire industry. So that category as well, just to, again, put things into perspective here, is up 21% year over year in terms of the flows, so growing at a very fast clip. Matt, can you share a few reasons why you think these have been so compelling to investors and why you think that they should be considered as a core building block for portfolios?
Absolutely. This trend has certainly been a wave. The all-in-one asset allocation ETFs have really taken off in Canada, driving inflows, driving sales, across the industry. Month over month, we see record inflows. As you said, close to 20% of inflows this year on a record year are in these all-in-one asset allocation ETFs. Many investors look at the opportunity to buy a managed multi-asset portfolio, a single ticker, a low overall cost as something that, I'll be honest, it's too simple, too easy to pass up. Many investors, retail and advisor alike, have made these fundamental building blocks within their portfolios, within their strategies, depending on the specific client type. So, why are these so compelling? Fundamentally, investing in asset allocation over security selection, I think that's a trend that is continuing to pick up momentum, get more widespread. Investing long-term in the benefits of a balanced asset allocation over time has a proven track record of outperformance. If you just look at the SPIVA data, if you want to back that up and see where, over the long term, asset allocation has been the main driver of fundamental long-term performance. These all-in-one solutions, they're also globally oriented. I think that is a unique attribute. Diversify your portfolio away from a Canada or US bias, open it up to the rest of the world without really having to pick and choose those ETFs yourself. That's a challenge in itself for many investors. These ETFs, they do it for you. Another big benefit, the ease of rebalancing. So, if you look at that auto rebalancing feature, these are really set it and forget it investments. So for a lot of investors, they are getting the benefits of professional management. They're getting rebalances regularly, whether it's quarterly or semi-annually, allowing you to ensure that you're getting the exposures that you want as the market changes, and you don't have to do anything about it. And I think that is a fundamental ease of use where a lot of investors said, yeah, this makes investing that much easier. Finally, and a big driver here, it's fees. The multi-asset solutions are extremely low cost. And at BMO, we offer an entire product suite at the lowest cost in the entire industry at 15 basis points. So, invest based on your risk tolerance from a conservative portfolio all the way to an all equity portfolio. If you look at ZCon, ZBAL, ZGROW, ZEQT, ZMI, if you want more monthly income, we have an entire suite at 15 basis points that would help investors get an all-in-one solution. And we feel that this is going to continue to be a driving force in sales and in inflows as we go forward.
Thanks so much, Matt. And for the benefit of our listeners, Matt did reference the SPIVA data. So I should just expand a little bit upon that. So what SPIVA stands for is S&P index versus active. So if you do a quick Google search, SPIVA, you'll see these reports come up. They're published twice a year by Standard & Poor's. And what they do is it's a publication that shows the percentage of active managers that are underperforming their respective benchmark indexes over different time periods. So over 1 year, 3 years, 5 years, 10 years, and up. And certainly it's been a very compelling argument to include a portion of your portfolio, at least in index ETFs. Because over the longer term, the longer the time period, the less likely it is to have an active manager that consistently is able to outperform their benchmark. So it makes sense to have the benchmark as a part of your total allocation. So that's a little bit of background on that. And I should also add, that's not to say that active management doesn't have a place in portfolios, because there's certainly going to be times where active management will outperform, or also specific areas of the market where it makes sense. Also, investors who need to lower their risk level or have tax efficient cash flow strategies might also want to consider active management strategies for those purposes. So I just wanted to clarify that. Next and final question, Bipan, over to you. We're seeing inflows into gold and silver bullion ETFs. The commodities continue to make new highs. And of course, on the BMO shelf, we do offer several exposures to gold. You did reference actually one just a moment ago, but we have ZGLD, which is the BMO Gold Bullion ETF. We've got the ZWGD now, which is the BMO Covered Call Spread Gold Bullion ETF, which allows you to get a little bit more cash flow and still hold physical gold exposure. You have ZGD, which is the Equal Weight Global Gold Index, which is global portfolio, of global gold miners, will be equally weighted between larger cap and sort of medium cap companies. And then, of course, you have ZJG, as you mentioned earlier, which is our BMO Junior Gold Index, which is an ETF of miner companies. So what's your top choice within the BMO lineup to gain exposure to the precious metal in portfolios right now, and why? How would you play it?
Yeah, it's an interesting question. It's a good question to ask, especially at this point when we've seen gold rally to the degree that it has over the past couple of years. And people ask me all the time, are you still constructive on gold even after this tremendous rally? And my answer is unequivocally yes, right? Because we have to think about the fundamental factors that are driving this rally. And there's two that I'll point to. Right. The first one is, again, if you go around the world and if you ask central bankers that are managing the reserves, which are really the savings of a country, what are they allocating to? What are they thinking about allocating to most over the next 5 years? And, there are a couple of websites that do conduct these surveys. A lot of them say that they are going to increase their allocation towards gold at the expense of the US dollar. So we are going to see that reserve diversification play continue to work its magic. I mean, this is something that I think is structural in nature and not going away anytime soon. The second factor, and I think this is relevant, if we're talking about a backdrop where core inflation is going to be a bit higher than expected, guess what? Traditionally, if we look back in history, that's usually does coincide with periods where stocks and bonds tend to be more positively correlated than not. right? So you really have that diversification problem within the portfolio. And guess what? Gold is a great diversifier. So you are getting that also that the benefit of residual demand come from the diversification aspect of gold prices. So if you're looking at just those two themes, and if you're looking at, if we can extend that to silver as well, I mean, these are structural factors that, we believe that are going to continue to provide tailwinds for gold on a go-forward basis. And if you want to play that, to me, there's no better way to play it than through our BMO Gold Bullion ETF, which is ZGLD, which cuts out the noise from individual companies that you get. There could be, say, company-specific idiosyncratic risk that you need to contend with if you're looking at something like a ZJG, which we mentioned earlier is the BMO Junior Gold Index. Again, that's great if you're looking at things from a sector-specific perspective, but if you're looking to play gold, to me, it's still ZGLD. Now, don't get me wrong, we will be in those periods where gold prices will consolidate for an extended period of time. Of course, not everything moves in the form of a tractor beam up, and there will be periods of consolidation. During those phases, if you want to get a little bit more tactical, maybe rotating out of something like ZGLD towards something like a ZWGD, which is our BMO covered call spread gold ETF. Could be something to consider. So again, remember with that, you are tracking the price of gold on a one-to-one basis up until a certain point, at which point the tracking does get cut to a significant degree, and you're still harnessing the yield, which makes it an attractive product. But really, that's more in our minds an ETF that you look at when prices are consolidating in the underlying, I would say.
Well, thank you so much, Bipan, and thank you, Matt. Always a pleasure chatting with you, gentlemen, and great getting your thoughts around recent industry flows and where things might go going forward. I'd also like to say thank you to all of our listeners who tuned in today, and don't forget to join us again next Thursday on Views from the Desk. Thanks, everyone. Take care. Have a good day.
The viewpoints expressed by the portfolio managers represent their assessment of the markets at the time of publication. Those views are subject to change without notice at any time without any kind of notice. The information contained herein is not and should not be construed as investment, tax, or legal advice to any party. Investments should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance. Any statement that necessarily depends on future events may be a forward-looking statement. Forward-looking statements are not guarantees of performance. Commissions, management fees, and expenses, if any, all may be associated with investments in exchange-traded funds. Please read the ETF facts or prospectus before investing. Exchange-traded funds are not guaranteed. Their values change frequently, and past performance may not be repeated.
Views from the Desk has been brought to you by BMO Global Asset Management.